In 2002, WorldCom was the second largest long-distance telephone company in the United States. It carried a large share of the nation's internet traffic. Its rising stock had made its executives and thousands of ordinary employees wealthy. Then, over a single summer, the company admitted that more than $11 billion of its reported profit had never existed. At the time, it was the largest accounting fraud in American history. The fraud was not exposed by the company's outside auditor. It was not caught by the Securities and Exchange Commission. It was found by a small internal audit team working nights in secret, using borrowed software, quietly investigating the very executives who signed their paychecks. This is the story of the control that was supposed to stay silent, and the people who refused to let it. WorldCom began far from Wall Street. In 1983, in a coffee shop in Hattiesburg, Mississippi, a group of investors sketched a plan for a discount long-distance company. One of them, a former basketball coach and motel owner named Bernard Ebbers, took over as chief executive in 1985. Ebbers grew the company by acquisition. Over 15 years, WorldCom bought more than 60 companies. In 1998, it completed a $37 billion merger with MCI, one of the giants of American telecommunications. A business that started by reselling phone minutes was, by the end of the decade, worth roughly $180 billion. Ebbers built that empire on a rising share price. He used WorldCom stock as currency to buy other companies, and he borrowed heavily against his own shares to fund private ventures, including a Canadian ranch and vast tracts of timberland. As long as the stock climbed, the machine worked. Around 2000, it stopped. The telecommunications boom cooled. Regulators blocked a planned merger with Sprint. Competition drove prices down. WorldCom's costs, especially the fees it paid to route calls across other companies' networks, kept climbing while its revenue flattened. The company faced a simple and dangerous gap, the space between the profit Wall Street expected and the profit the business could actually produce. Chief Financial Officer Scott Sullivan closed that gap with accounting. The central move was deceptively simple. WorldCom paid billions of dollars in what are called line costs, the fees it owed other carriers to carry its traffic. Those are operating expenses. Under the rules, a company must subtract them from revenue in the same period they occur. Beginning in 2001, WorldCom's finance team stopped doing that. They reclassified these everyday costs as capital expenditures, as if the company were buying long-lived equipment. They even coined a term for it that appears nowhere in accounting standards. They called it prepaid capacity. The effect was to lift billions of dollars of ordinary costs off the income statement and park them on the balance sheet where they could be spread across many years. Expenses disappeared. Profit appeared. WorldCom shifted more than $3.8 billion this way at first. The final figure would grow past $11 billion. Every public company is supposed to have layers of protection against exactly this. An outside auditor reviews the books. In WorldCom's case, that firm was Arthur Andersen, the same auditor then collapsing over its role at Enron. A board audit committee provides oversight, and an internal audit team, employees whose job is to test whether the company's own controls actually work, sits inside the business. That last control carries a built-in weakness. At many companies, internal audit reports in practice to the same executives. It is meant to scrutinize. It is very hard to investigate the people who control your budget and your job. WorldCom's internal audit was led by a vice president named Cynthia Cooper. In early 2002, a manager in the wireless division complained that Sullivan had stripped away financial reserves her unit had built. When Cooper's team pulled the thread, the numbers stopped adding up. A finance director explained part of the gap with those same two words, prepaid capacity, and could not say what they meant. What Cooper did next is the heart of the story. She and her colleagues, including an auditor named Gene Morse, kept investigating without telling senior management. They worked after hours, at night, because they feared being shut down if the executives learned what they were tracing. Morse used internal software to pull the actual journal entries. He found billions of dollars in costs capitalized with no invoices, no documentation, no justification of any kind. When the team confronted the controller, David Myers, he admitted he had no support for the entries and would not create any. On June 20, 2002, Cynthia Cooper laid the findings before the board's audit committee. 4 days later, the committee forced the issue. Scott Sullivan was fired. David Myers resigned. On June 25th, WorldCom told the world it had overstated its profit by more than $3.8 billion. The end came quickly. On July 21, 2002, WorldCom filed for bankruptcy. With more than $100 billion in assets, it was the largest corporate bankruptcy in American history to that point, larger even than Enron. The full restatement of fabricated earnings eventually passed $11 billion. The consequences reached the top. In 2005, Bernard Ebbers was convicted of securities fraud, conspiracy, and filing false statements with regulators. He was sentenced to 25 years. He insisted he had never understood the accounting, that the fraud belonged to Sullivan. The jury did not believe him. Sullivan pleaded guilty, testified against Ebbers, and received 5 years. Ebbers was released in December 2019 for failing health and died weeks later in February 2020. Cynthia Cooper's team earned a different place in the record. At the close of 2002, Time magazine named her, alongside Sharon Watkins of Enron and Colleen Rowley of the FBI, its Persons of the Year, 3 people who told the truth from inside institutions that did not want to hear it. WorldCom changed more than its own story. The near-simultaneous failures of Enron and WorldCom convinced Congress that the checks around public companies had broken. In July 2002, weeks after WorldCom's disclosure, the Sarbanes-Oxley Act became law. It required chief executives and chief financial officers to personally certify their financial statements. It required companies to test and report on their internal controls. It created an independent board to oversee the auditors themselves. Much of the compliance and audit architecture that professionals work inside today traces directly to this moment. Here is the lesson. Strip down. WorldCom had every correct control on paper: an external auditor, an audit committee, an internal audit function. The fraud still ran for more than a year, because the people who authorized it also controlled the budgets and the careers of the people meant to check it. What broke the fraud was not the structure. It was that one team treated its independence as real and was willing to turn it on its own leadership. A control is worth exactly as much as the willingness to enforce it. That is the whole difference between a safeguard on paper and a safeguard in fact.